Welcome to Spreadsheet Geek. In this video, we're going to explore a topic many people struggle with, including many business owners. This topic is the two-column accounting system where business transactions are entered through balanced debit and credit entries. We'll launch a fictitious business and monitor business transactions for a year. By the end of the video, you should have a basic understanding of how the two-column accounting system works. This video was made using Microsoft Excel 2019. The two-column accounting system has been in use for literally thousands of years. Today, the system is still in use with mom-and-pop enterprises all the way up to the largest companies in the world. Before we go any further, we need to define the terms debit and credit. You may be familiar with these terms from your bank statement or your utility bill, but they have a slightly different meaning in accounting. In the two-column accounting system, the terms debit and credit have quite literal meanings. A debit entry is an entry on the left side of the account, sometimes called the left side of the ledger. A credit entry is an entry on the right side of the ledger. Taken alone, that's all you need to know about debits and credits. But you should be aware that sometimes a debit is an increase to an account and sometimes a credit is an increase to an account. It just depends on what kind of account it is. If a debit increases the balance of a particular type of account, a credit will decrease it, and vice versa. Debit and credit entries flow onto two financial statements. One of them is called the balance sheet. The balance sheet is a listing of assets, a listing of liabilities, and the difference between those two, which is referred to as shareholder equity or owner's equity in the case of a sole proprietorship. It's important to note that the balance sheet is a snapshot in time. It has a single date at the top. It does not reflect changes in assets or liabilities over time. All of the accounts on the balance sheet are referred to as real or permanent accounts because they don't get zeroed out at the end of a fiscal period. That being said, an asset or liability account may go to zero when a loan is paid off or an asset is sold, but the year-end closing process does not affect most of the accounts on the balance sheet. We can pull this basic equation from any balance sheet. Usually assets are bigger than liabilities and there's some positive equity, but it doesn't necessarily have to be that way. This is a very important equation, and usually when it's expressed, the liabilities are moved over to the right side of the equation so that all three factors are positive. This equation is known as the accounting equation. The entire two-column accounting system is derived from this equation. We must always keep this equation balanced. Let's take a closer look at this equation and how debits and credits flow into these three areas. An increase to an asset account is a debit. A lot of people struggle with this one because they see their bank statement where the bank debits their account for a bank fee, and that's taking money away from the account holder. But look at it from the bank's perspective. They're taking money away from an account holder and adding it to their assets. That's the perspective you should keep in mind when you debit an asset account. An increase to a liability or equity account is a credit. Credits to liability accounts are fairly common, but credits to equity accounts are fairly uncommon. Most of the time, changes in a company's equity are the result of changes in assets or liabilities of the company. There's two slides in this presentation I recommend you memorize, and this is one of them. If you can memorize what increases those accounts, you can always recall what decreases them. I think it's easier to just memorize the increases. Before we launch our fictitious business, we need to talk about that other financial statement. It's called the income statement. The income statement reflects a period of time, usually a fiscal year or fiscal quarter, sometimes a month. The income statement tracks income and expenses, resulting in a profit or loss. Sometimes this statement is referred to as a P&L or profit and loss statement. All of the accounts on the income statement are referred to as nominal or temporary because at the end of a fiscal period, those accounts are all zeroed out and the resulting balance transferred to a balance sheet account called retained earnings. At that point, the company would start a new fiscal year with a blank income statement. Built into the income statement is another equation. We need to define what an increase in income or an increase in expenses is in terms of debits and credits because some of our two-column entries will affect these accounts. This is the other slide I recommend you memorize. An increase in income is a credit and an increase in expenses is a debit. If you can remember what the increases are, you'll always be able to remember the decreases. Let's get on with our business. We're going to launch a t-shirt business. We're going to buy blank t-shirts, put designs on them, and sell them to customers. We need some capital to start our business, so we're going to take out a bank loan. To keep things simple, this will be an interest-free, government-sponsored small business loan where we just pay back the principal. We also have some personal savings we're willing to invest in the business. We'll invest periodically in inventory items, including blank t-shirts, ink, and packaging materials for shipping to customers. And those three items will go into our inventory accounts. We'll restock those on occasion when we need to restock them. We'll make a significant investment in a printing machine that allows us to transfer the ink onto the blank t-shirts. This is a fixed asset that will depreciate over the long term. We don't need much space for our business. We'll just occupy a corner of Mom's basement, but we will pay Mom a little bit of rent each month to make it legitimate. We won't have any accounts receivable. All of our customers will pay in advance with a credit card and we'll ship the t-shirts out through the mail. This is a one-person business with one employee, owner, laborer. Now, obviously, there would be other costs involved. We would probably have some business insurance and a website fee and a phone bill, but I'm going to overlook those to keep this simple. The point of this is to show how debits and credits flow onto the financial statements. Let's get started with our business. I've laid out a balance sheet and an income statement with the accounts we'll be using, and there's one key difference between my balance sheet and income statement and what you would see in a company's annual report. I've separated the debits and the credits. Keep in mind that for any account, such as cash, the balance, there would only be one column and it would be the result of the debits less the credits. That would be the one balance displayed. But we're going to break this apart and enter transactions one at a time. And I've tallied up my totals for debits and credits at the bottom of each two-column ledger. The first transaction we talked about was a loan from the bank, so we'd have some capital to run our business. It's going to be a $1,200 loan, and we're going to pay it down at $50 a month over 2 years. So a loan is where you receive cash. So I am increasing an asset account called cash. If you remember from those very important slides, an increase to an asset account is a debit. So I'm going to enter a $1,200 entry on the debit side. I have to enter a $1,200 credit entry, and that entry will go to an account called loan under liabilities for now. The second transaction we talked about was raising additional capital through our own savings. The amount that we're going to put into this business out of our own savings account is $2,000. So I'm going to go ahead and increase this cash account with another debit for $2,000. Now I have a difference in debits and credits, so I need to put a credit somewhere, and that credit's going to go down here in common stock, $2,000, and we're going to go ahead and state that as 20 shares at $100. That's not really important to know. What's important to know is that we now have a shareholder with $2,000 in equity. Next, we're going to buy that printing machine. That's going to cost $600. So I'm going to make an entry here that our cash will go down by $600. And we're going to increase an asset account called printing machine. An increase to an asset account is a debit, so we'll enter into that column 600. This accumulated depreciation account will be used later in subsequent months as we depreciate the machine, and we'll depreciate that machine at a rate of $10 a month. So I'm looking good. I've got some capital, I've got a machine, I've got balanced debit and credit columns. I need some inventory now, so let's buy some inventory. We're going to spend another $800 on blank t-shirts and ink. And for our purposes, I've grouped both of those items into raw materials. We have 3 inventory accounts: raw materials, finished goods, and packaging. Raw materials are the raw materials that go into our finished product. So that's why I've broken out packaging separately. The amount of raw materials that we're going to invest in is $800. So that's an increase to an asset account or a debit. And of course, I'm going to pay cash for that. So I'm going to credit cash for another 800 over here. I'm still balanced. In similar fashion, we're going to buy some packaging materials. I'll increase that asset by $200, and that'll come out of cash because we're paying cash. So that's a decrease to my cash account. Still balanced. So in this first month, we're going to convert $200 of our $800 in raw materials into finished goods. So that's an increase of $200 to finished goods. That's a debit. And I'm going to take this balance down by 200. So my raw materials inventory is now 800 minus 200, or 600. I've moved it over here. Now, in order to do this, we need to spend $240 on labor. This is the first time that the income statement's going to come into play. Labor expense is a monthly expense. It's not on the balance sheet. It's over here. We have to pay that out in cash. So that's going to be a $240 debit to labor. That's an increase to that account. And we're going to decrease cash by $240 by increasing that balance. Now, for the first time, we have an imbalance on the balance sheet and an imbalance over here. So what I'm going to do is bring in a trial balance to keep these straight. So here's my trial balance, and this is just a sum of all debits and credits. My debit balances I put in red, and those will flow into this number, and my credit balances will flow into this number here. So we look good, we're still equal. The next transaction we're going to enter is the sale of some t-shirts. This is good news, we have our first sales. What we're going to do is sell $800 worth of t-shirts. So that's these $200 in finished goods. We actually sold those for $800. So I'm going to enter a credit, which is an increase to an income account. That's a credit for $800 here. And I need to put an $800 debit somewhere. And that's going to go to cash because those customers paid in cash in advance, and that money goes straight into our bank account. Now, there's additional entries that need to be made with a sales transaction typically, and one of them is cost of goods sold. So these finished goods, they're gone. Those are now part of an expense account, which we're going to increase by 200, called cost of goods sold, or COGS. I'll refer to it as COGS for the rest of the presentation. And of course, our finished goods inventory is an asset, and that needs to be decreased by $200. We just wiped out the whole inventory. 200 minus 200 is 0 for that account balance. In addition to the finished goods inventory, we needed to use some of our packaging inventory to send those t-shirts out. We're going to recognize $50 of that inventory into COGS plus 50. And my packaging inventory is going to be decreased with a credit of $50. So how are we looking at the bottom here? Our trial balance is still balanced in terms of total debits and credits, although some have entered the balance sheet and some on the income statement. So we're almost done with the first month, but we've got 3 entries we need to make for general housekeeping of our financial statements here. We said we were going to depreciate our printing machine at $10 a month over 60 months. So over a 5-year period, it would be straight line depreciated to 0. So I need to enter $50 over here on the income statement for my monthly depreciation of $10, and we'll make a credit entry to balance that here in accumulated depreciation. So I'm still balanced. Now our next housekeeping entry will be for the loan. We're paying down this loan at $50 a month over 2 years. So I need to take away $50 from cash with a credit, and on the other side of that entry, I will decrease our loan balance, which is normally a credit balance, by $50. There's one other piece of housekeeping, and that is our rent. We're going to pay Mom $100 a month to rent that corner of her basement. So that's an increase to an expense account. That'll be a debit. And on the credit side of that one, again, is going to be cash. So let's hit the bank account with a credit for $100. So we've completed our business operations and accounting entries for our first month of January. There's 2 things I'd like to point out. Our debits and credits are equal, so that's looking good. And I'm going to add a section here to our income statement. This cell equals our income credit minus our expenses. So this is our monthly income for January, and I'll leave that on there from now on. We actually turned a profit after all of our expenses were booked. One more thing I will point out is that this labor technically should be in cost of goods sold, or at least some of it. The part that was spent making t-shirts should be included here, but I'm going to leave that out of this problem for sake of simplicity. We would need some sort of method to allocate some of this labor into cost of goods sold, but let's overlook that. Okay, very quickly, we're going to go through the February and March periods, and we're just going to lump all those accounting entries together. The first thing we're going to do is convert some more of our raw materials. We have a $600 balance in raw materials. We're going to take 400 of it out and convert that into finished goods. So I'll go ahead and debit finished goods for the other side of that $400 transaction. That's going to cost us $480 in labor. So I'm going to add $480 over here to make those t-shirts, and that's going to cost us $480 in cash. So I'll credit cash for $480. Next, we're going to sell $1,600 worth of t-shirts in February and March. So that'll go as a credit to revenue. And on the other side of that transaction is cash. So our bank account balance would go up by $1,600. Whenever we recognize a sale, we need to recognize cost of goods sold. So I'm going to increase that by the 400 for the actual shirts that are in my finished goods inventory right now. So I need to clear out my inventory again with a $400 entry. 600 minus 600 is 0. And I also need to recognize COGS for another $100 for packaging. That took out 2 months worth of packaging. We've been spending about $50 a month, so there's another 100 there. So at the end, I've got a few more housekeeping entries to go, but we've got a good looking trial balance. Let's finish up with those housekeeping entries. The first one is we need to recognize 2 months worth of depreciation. So that's an increase to an expense account. That'll be $20 there. And we'll offset that with an entry of $20 to accumulated depreciation. Accumulated depreciation as an account is no different than any other credit account. It's called a Contra account. And basically all it does is rather than present the printing machine value as 600 minus 30, they break it out separately with fixed assets, very often to preserve the original cost of that machine on the balance sheet. So these two accounts would appear separately on the balance sheet normally. Next, we need to make 2 loan payments in February and March for $100 total. So I'll just enter that as a $100 debit. And we will take $100 out of our bank account with a credit. Last but not least, we have to pay Mom 2 months worth of rent. So that'll be $200 of rent expense. That's a debit. And that money will come out of our bank account as a credit. So at the end of March, after we've completed all of our accounting entries, we have equal debits and credits, and we continue to make net income at a rate of $200 per month for a $600 net profit. I'm going to go ahead next with the April through December period and simply enter all those transactions in rapid fire so that we can get to the closing entry process. At the beginning of April, the first thing we need to do is buy some inventory because our raw materials inventory is only $800 minus $600 or $200. That's getting kind of low. So we're going to buy $2,000 worth of inventory. That's enough to last the rest of the year. That'll be a debit for $2,000 to raw materials and a credit for $2,000 to cash. Next, we need to buy some packaging inventory, and that's going to be $600. We'll spend $600 on that, and that will also come out of cash as a credit. During the April to December period, we're going to use $1,800 worth of our raw materials and convert those into finished goods. So I'll increase that balance with a debit. And that's going to cost us $21.60 in labor. So that's going to come right out of our bank account. Now, don't be alarmed that our bank account has dropped below zero balance. We have overdraft protection, but in reality, this would happen over the course of months, and I haven't recognized any sales yet, and we're going to have sales to recognize next. My sales for the remainder of the year, those 9 months, is going to be $7,200, and that'll go right into our bank account, so that'll beef up that balance. Whenever I recognize sales, I need to recognize cost of goods sold. So that's going to go up by that $1,800 worth of inventory I made. And of course, I'm going to have to remove that from finished goods. So I just once again wiped out my finished goods inventory. I also need to recognize some packaging. That 9 months of sales will consume $450 in packaging, so that's a credit to my packaging inventory, and I'll put that into COGS. So after all of my sales related entries, I've got balance, debits, and credits and a net income of $33.90. But don't forget, I haven't recognized my depreciation, my rent, and loan payment. Depreciation expense for the remainder of the year will be another $90. So that's a debit to an expense account. And the other side of that entry is over here on the balance sheet with a credit to accumulated depreciation. In that 9 period, we will make 9 payments of $50 on our loan. So that's $450. That's a decrease to a liability account. So that's a debit. $450. And the other side of that transaction is, of course, our bank account. So we'll take $450 out of the bank account. And last but not least, in 9 months, we will make 9 payments of $100 to mom for rent. That'll be $900. And again, that will come out of our bank account. So this is where we would finish the year. We've got a balance in debits and credits. We turned a profit of $2,400 before taxes. We have adequate cash in our cash account, and our raw materials and finished goods accounts look largely depleted along with packaging if you take this number minus this number in each one of these. But other than that, we had a pretty good year. So let's look at our closing entries and see how these temporary or nominal accounts get transferred over onto the balance sheet into this account. I mentioned taxes a minute ago, but we're going to pretend like we don't owe any taxes because our net income is too low. So we'll keep it simple with no taxes. If you had taxes owed, you would probably want to recognize a liability at year end for taxes that you're deferring. That entry in all likelihood would be a debit to income tax expense and a credit to a liability account called deferred taxes. But that's a topic for another day. Now, make no mistake about it, the first thing you want to do when you're closing the books for the year is to check your trial balance or run a trial balance and make sure that all the accounts net to zero. Now, most accounting systems will force you to enter a debit for every credit, so it's kind of hard to miss that, but that is the first step. The next thing you need to do, remember, these income statement accounts are all temporary accounts. These need to be zeroed. So you would prepare a journal entry that offsets all of these. Yeah, I got one typo there. My net income has now been zeroed, but my trial balance has a difference of $2,400 on it after I would do that year-end closing journal entry with these 4 items on it right here. This $2,400 was what we had in net profit before, so that's going to go up here into retained earnings, which is an equity account. And when you increase an equity account, that's a credit. So that $2,400 will make my trial balance but go back to zero, and we are ready to start a new year. Those items I've highlighted in yellow make up the year-end closing journal entry. So all of the income statement accounts have been returned to zero, and all of the permanent accounts on the balance sheet are preserved. To illustrate this, I've created a balance sheet for the year end after the closing entry. So this includes the retained earnings. And I've hidden all of the unnecessary columns. This is how the balance sheet would look at year end. And you'll notice that we have assets, and I'll include accumulated depreciation in that. Assets equals liabilities plus owner's equity. So that asset total is $5,000, and the liabilities plus equity is also $5,000. So our accounting equation is balanced. This is our income statement before the closing entry. So it shows our income and expenses netting out to $2,400. If you found the content of this video interesting, informative, and useful, please hit my subscribe button. I'll be releasing one video a week for the foreseeable future, and I'm always looking for new topics, so please make a comment and give me a thumbs up if you think it's worthwhile. Thanks for visiting Spreadsheet Geek.